Mixed day for markets with the S&P 500 snapping a three-day losing streak and some institutional investors getting more cautious. But our next guest says retail investors taking the other side of that trade and getting more bullish. And joining us now is Michael Green, Simplify Asset Management Chief Strategist. Michael, always good to see you.
Yeah, it's great to be here, Josh. Thank you.
Maybe I thought I'd get your take on the economy here today, because we did get some different data points. New home sales rose. Initial jobless claims fell. Let's have business activity expand. What is your take about where we are and where you think we're headed?
Well, we also got the Chicago Financial National Activity Indicator, which was relatively weak, right? And so we have this dichotomy or this divergence effectively that's happening in the economy, where many parts of it are relatively weak and other parts of it, particularly those that benefit those who have assets that are earning much higher income, have had a fantastic year in the stock market, are doing relatively well. In particular around things like unemployment claims, et cetera. There's been a very substantive and structural shift in the US employment market around the gig economy, which really didn't exist in the last recession. COVID obviously set aside because of its unusual nature. But what we're actually seeing is we're seeing rising unemployment amongst youth groups. Ironically, that turns out to be the group that really isn't eligible to do things like drive for Uber or DoorDash, et cetera. For insurance reasons, many states limit those who can take those jobs to those over the age of 25. So we see actually kind of a natural experiment in the spread between what's happening in the 16 to 24 category and what's happening in those above. In that 16 to 24 category, we're actually still seeing unemployment extremely elevated. It's up about 400 basis points from its low that it was as recently as June of last year. That's where the economy is weakening. It's really hitting the young people who don't have assets, who are being affected by the much higher borrowing costs, who see their dream of buying a car or see their dream of buying a house getting further and further away from them.
But doesn't that sort of correct itself over time? And typically, we always talk about the differences among different tiers in the economy, but when we watch the market reaction, when we look at the economic data, it's obviously the big average, the big numbers, right? GDP isn't determined by the 16 to 24, by and large. It's determined by the people who are working, who have money.
So again, that's part of the reason why I brought up the Chicago Fed National Activity Indicator, because we're not seeing it all come up roses. But I agree with you with one notable caveat. Economies and individual actions are all about constraints, right? So if I have money in the bank and I lose my job, I don't necessarily have to cut back on my spending. But if I don't have money in the bank, even if I have a job, I might actually find myself suddenly constrained and being forced to trade down. We are absolutely seeing that at the lower end of the economy. We hear this from numerous retailers, restaurants, et cetera, that fast casual space is really being hammered on some of these components. When we actually look at those dynamics, it becomes a question, does it continue or does it heal? And that's what we simply don't know the answer to right now.
Let me ask you what you make of what we're seeing with yields. Michael, obviously front and center for investors. What do you think explains the move we've seen there?
Well, I think part of what we've seen in yields is simply the byproduct of an incredible rally that we actually saw in yields. So we saw 10s move from nearly 5% to about 3.5% over the past, give or take, 6 months. Now we're actually seeing that give itself back after the Fed's cut. That's not particularly unusual. Again, it becomes a question of what happens next. And so I'd mentioned in my communications with you things like the home building sector or the housing sector. Your last guest, I think, was very spot on in saying, look, this backup in yields has actually started to hit the market again. We're starting to see the impact of this, particularly in the existing home markets. I certainly am seeing components of that. And again, it just becomes this question of what happens next is relatively uncertain. We have a very wide choice between Kamala Harris and Donald Trump, between a sweep, between divided government. We simply just don't know a lot of stuff right now. And I think today is a really interesting indication of that, where you have somebody like Tesla, a relatively heavily shorted stock, blowing out earnings or delivering earnings that are well above expectations. The entire space associated with that, the most shorted stocks, et cetera, all rallied sharply today. That tells me there was some real pain felt from the short community.
So put it all together for us, for investors in this market, and kind of taking it back to where we started, which is that there are some institutions now, like a Goldman Sachs, who are saying, that we could see lower returns than we have. There are plenty of banks, though, who say that returns are going to be just fine. And then we have retail investors on the flip side who are still putting a lot of money to work.
Well, I think this is actually part of what's so interesting about it is if you look at the retail perspective, they're absolutely putting money to work. Vanguard conducts a really interesting survey of their investors, asking them what their long-term expectations for equity returns are. those have actually started to rise, even as Goldman Sachs and frankly Vanguard itself, their strategists are actually projecting 3 to 4% returns out of US equities going forward, well below the averages. But Vanguard customers, having grown accustomed to watching their portfolios rise as rapidly as they have, are now starting to bake in 8, 9, 10% sort of returns into their expectations that ironically are actually hitting like the 95th percentile possible outcomes that the strategists are calling for at the same firms. So there is this wide divergence that seems to be developing in terms of expectations around the stock market. At the end of the day, it's the people with the money that rule, though. So if they're going to continue to pile that money in, if they're going to continue to put it to work, you'll see days like today where things are pushed up.
Michael, when you're talking to your clients right now, what is the number one question you're feeling and getting?
I think the number one question is always about explaining the performance of the stock market, right? People are actually, ironically, not super interested in the economy. They're much more interested in what's going on in the stock market. And I think that's one of the key challenges that we face. As you guys know, I have some heterodox views around how important earnings are or how important valuation is to the stock market. I really think ultimately things like 401k flows, pension flows, et cetera, dominate in terms of the overall behavior. As long as those continue, we should continue to see elements of what we've seen on the course of this year, which is the larger market cap companies continue to benefit, continue to attract the most flows. They are not liquid relative to the size of those flows that are coming in. That's pushing them up higher. Other areas of the market are much more challenged simply because they're subject to inattention.
Michael, always great to see you on set. Appreciate it.
Thank you very much.